Hey everyone, and welcome back to another couch investing portfolio. Over the past week, which was a shorter week, the couch investing portfolio was basically flat, was up 0.14%, whereas the S&P 500 was up 1.78%. Year to date, we are still in the green. We are still up just over 2%, whereas the S&P is up 0.56%. And since the start of the portfolio, we are still up 62.98%, whereas the S&P is up 18.65%. This is what your favorite stocks have done over the past week. And this is how we closed out the week on Friday. Now in today's episode, I do want to go over the upcoming earnings week. We're towards the end of this earnings season. A couple of macro-related items, comments from Donald Trump and Scott Bessent, and then again, some more data macro-related, and I'll touch a little bit more on the portfolio and a couple of positions. And so if you enjoy this type of videos, hit the thumbs up button, subscribe if you're not, especially if you're new here. We're trying to reach 100,000 subscribers. So the more of you hitting that subscribe button, it's free, the quicker we will get to that milestone. And then you can unsubscribe if you want. And of course, share your thoughts on the current market situation, any specific stocks that you have been looking into more recently. Are you waiting for a pullback? Have you been raising more cash? Let me know down in the comment section below. And if you want me to review a specific company, has to be a good one, let me know in the comment section as well. All right, so a quick portfolio overview. As we can see, not much has changed in the rankings here. Maybe throughout the week, if you're following this portfolio, maybe Rocket Lab was a bit higher because the stock was also a little bit higher. But other than that, nothing much has changed. I didn't sell anything. I didn't buy anything either. I mean, the last couple of things that I did here was one, I added AST Space Mobile to the watch list. And well, at the start of May, I just bought one share of Palantir just for the sake of it. And I added cash. Now it's almost a month later and I haven't done anything. The only thing that I will do probably in the next couple of days is again, increase the cash position in order for me to be, well, better prepared if we have a pullback. I don't know if the pullback is going to happen or not. This truly is a hated stock market rally. So better be prepared in case there are pullbacks and opportunities. I'm already seeing here a couple of names that I think I'll add a little bit more to. I think Alibaba, I'll increase my position a little bit more. Maybe AMD as well in anticipation of that June 12th event. And then the others, I'll be opportunistic. Like I said, Nebius, if it goes closer to $30 or maybe even below, if that ever happens, I'll for sure increase my position. And the same with the others. I have specific price targets that I'd like it to hit before I increase my position, but I'm in no rush. That's why I want to increase the cash position just to play it a little bit safe. All right, now looking at the upcoming days when it comes to earnings. On Monday, nothing special. On Tuesday, before the market opens, Dollar General, NEO, if you're interested in that. After the market closes, I guess the big one is CrowdStrike, although I'd say that Couchbase might be an interesting company to look at. First time that I'm seeing this right here, although I guess I can maybe still have my own ticker Couch if I ever go public. Good to know. On Wednesday, we've got $3 before the market opens. After the market closes, MongoDB, 5 below, Planet, ChargePort, and that's about it. And then on Thursday, before the market opens, other than Victoria's Secret, I don't think anything else is very interesting. After the market closes, we've got Broadcom, DocuSign, and Lululemon. And so, yeah, we are nearing that end of this earnings season. And well, we are closing in on that start of the new one, but only a month or so from now. At the end of June, we will have Micron report their quarterly figures. So here, this is what happens in the upcoming days. Moving on to the data part of the video. So we've had the PCE price index, or the personal consumption expenditures price index, which is the Fed's preferred metric here. Now in April, that came in at 2.1%, but if you exclude food and energy, the PCE price index increased 2.5% from a year ago, which is better than the 2.7% that we've had before. So yeah, I guess rate cuts are coming or not. Remains to be seen. Scott Bessent had an interview with CBS and he said the following thing. On the US-China relations, Bessent believes President Trump will engage in discussions with China's President Xi in the near future. China is reportedly withholding products crucial to the global industrial supply chain. Well, this is the back and forth accusation. And Bessent asserted that the United States will not default on its debt obligations. Well, let's see about that. But touching back on this whole tariff story, it seems like right now in June we were going back full on the tariff headlines. As I've said previously, I think the most important part of this whole tariff thing is to actually have trade deals. Because the more trade deals you make, the less these tariff headlines will hurt the economy, will hurt the perception of how bad or how good we have it right now. Make the deals and move on. As for the statements from President Trump, he indicated that Japan is seeking a trade deal with the United States. He also mentioned ongoing trade discussions with India and Pakistan, noting that Pakistani representatives are expected next week. That's going to be very interesting. Trump stated his intention to increase US steel import tariffs to 50%, and I believe that right now some automakers in Europe are getting hit on Monday. Then we've had a little update here from Tom Lee from Fundstrat Capital. So he talked about the most hated rally. So this is still the most hated rally despite having a V-shaped recovery. There's a sizable perception gap. Tariffs are a bark worse than a bite. Now what does that mean? Well, as you remember, last week we've had the headline where the International Trade Court ruled against Trump tariffs. Then DC District Court Contreras rules tariffs illegal. But then we went back to, okay, that happened, but the tariffs are still in place. So it was 24 hours of, okay, great, maybe tariffs are off the table, markets were green, and then we're back to actually, no, nothing has changed just yet. Then he says here the following things. Tariff threats are leading to concessions, Doge cuts less than expected but led to concessions as well, and then the budget bill less cuts than expected but led to concessions. So he still believes that we are going to get, compromises basically. As for the other points here, hedge funds increased short interest recently. Now you might think we are having a V-shaped recovery. Hedge funds should not be increasing their short interest, they should be decreasing it, but no, the exact opposite has happened. Most hated rally, I guess. And that's going to be quite interesting to see, because if we continue to go up, I guess there will come a time where they will just have to decrease it and start buying. There's also $7 trillion cash on the sidelines. There's always been a lot of money on the sidelines. That doesn't always mean that it's going to be, put into the stock market. And then as for the investment outlook, it's better now than in February 2025. I guess I'll have to slightly agree. I say slightly because yes, it's true. We have so-called tariff visibility. We have tax and deregulation visibility, and the Fed could be more dovish in 2026. Again, I say slightly agree because tariff visibility, things can still change quite drastically. And tax and deregulation visibility, again, we don't know how fast these things will come. So I will have to slightly agree with this. Then with the Fed being more dovish in 2026, yes, okay, it depends, of course, how many cuts we're going to have this year. I still think we're going to have a minimum of 2 cuts. And like Tom Lee has said, like I've said, and plenty of others as well, the longer you can keep this rate cutting cycle, the longer you can stretch the bull market. And here the short baron on X shared the following. Hedge funds are in major trouble and are close to going on a major chase buying spree. Leverage stands at 74% on the prime book and the LS book is at a mere 50%. This is worst case for money managers. Talking here again about the number 3 point here, hedge funds increasing short interest. Moving on here to the treasuries. So, long-dated bond demand remains elevated even amid selling pressure. TLT just saw a weekly inflow of $1.8 billion, the highest inflow among all ETFs. As for first-time home buyers, a share of home purchases are now down to record lows. Looking at M&As, it doesn't look that great either. Deal signing falls to 20-year low, worse than during the global financial crisis. The number of deals inked globally fell to their lowest in April since February 2005. And it has actually been crashing since, 2021. Then the last couple of things here. China's treasury holdings have fallen below those of the United Kingdom. The number one here still being Japan. And as you can see, Canada, Belgium have actually been increasing it over the last couple of years. Looking at data of what has happened previously and might it happen again in the future. So in this case, S&P 500, after up more than 18% over the past 35 trading days, which is 7 weeks. We don't have that many data points to work with, but we have a couple. And here, as you can see, a week later, 2 weeks later, well, let's call it 50% of the time we were green, but the first one a week later, on average, we were still down 0.57%. 2 weeks later, although only 57% of the time we were green, on average, we were up 2.12%. And then the further out we go, well, the better the odds are for us. And on average, well, we're going up and up and up more and more. Now, what about the next couple of days? Well, a day later, 0% of the time we were green. 2 days later, 43% of the time we were green. We were down on average 0.15%. And then 3 days later, 57% of the time we were green. On average, we were up 0.14%. Then again, we go back down and down again. Only 2 weeks later was it 57% of the time we were green, but we're up 2.12%. And as I've said at the start, we have a V-shaped recovery. I am going to increase my cash position because we don't know, right? We don't know. I am enjoying the rally that we have. And if we continue to go up, great. But for me to feel more comfortable, for me to say to myself, actually, I don't have to make any rash decisions right now because I do have cash on the side. So I'm chilling. If there are opportunities, I know I'll have cash to take advantage of those opportunities. Because there were some times that, well, there were opportunities, but I didn't have that cash, right? I didn't have that cash, and so started to make dumb moves. Making dumb moves is not the greatest thing in investing. Will I make dumb moves in the future? Yeah, probably. But right now, I'm trying to minimize the dumb to smart move ratio to make sure that I have more smart moves than dumb ones. And having an increasingly big cash position definitely helps with the emotions. And so that's about it. That's the plan. Increase the cash position over the next couple of days, maybe next week, depending on, well, the cash flow, and then see if there are interesting opportunities to add more to existing positions. I am not in a state where I want to open up a completely new one right now. Maybe for a short-term trade, yes, that's always possible. But for a long-term position, I don't think I will open up a new position here. Plus, I do think that I have plenty of positions that I can still increase more and more. I don't have to look elsewhere because the opportunity is still there for plenty of these names, if not all of these names over the longer term. You might not agree with it, and that's completely fine. You don't have to agree with it because that's the beauty here. It's my portfolio, not yours. If you do not like a certain stock here, you do not have to own it. If you disagree with the thesis, that's also fine. I buy it because I believe in it. I will be right, I will be wrong, remains to be seen, but it's my money, my mistakes, and my gains. So overall, that's about it. That will be it for me in this video. If you enjoy this type of videos, hit all the buttons, especially the subscribe one, and I'll see you all in the next one. Bye-bye.